Hello. In this video, I want to talk to you on a more applied basis about how to derive operating cash flows from financial statements, primarily income statement and balance sheet for a company that uses accrual accounting. That should be most of the publicly available financial statements, and quite frankly, that's the most common accounting method used by most businesses. So it's a common enough thing that comes up that it is worthwhile walking you through this. So the overall objective from this is that you will have times where you won't necessarily be able to get directly to the cash flows that you're looking at. You'll be provided with some sort of a forecast or maybe historical data on a accrual basis, and you'll want to be able to extrapolate from that forward, but you first have to convert it into operating cash flows to do that. And so the goal is for you to be able to explain how you would go about doing that and then create an example of your own design and demonstrate how you would do that. You'll see as I go through this that I have created an example in a spreadsheet that is similar to the project that I am doing as my example, and that I am doing this for multiple periods. So I'm really taking a forecast and converting it. I don't require you to do it for all those periods. You just need to do it for 2 or 3 periods to show that you know how it would work. Okay. So let's first talk about kind of recall for yourself what we mean by operating cash flows. They are cash sales. So sales from operations. They are less the cash from operating expenses, right? And then you subtract again from that taxes, and you want cash taxes, and you also want those taxes to not include benefits from interest expense, because that would be a commingling issue. You want to subtract any amounts that you spent for asset purchases, and you want to add back any amounts for asset sales. That is conceptually what you would want. Well, the deal from an accrual basis is that you're going to get sales amounts, and those sales amounts are going to include things that are sold in the period, but that you didn't actually collect cash for. They're also going to include, they're not going to include things that you sold last period, didn't get cash for, but you got the cash this period. So you've got both of those issues. On the expense side, you're going to have sort of the same issue there as well. They are going to include amounts that you purchased today, even though you maybe didn't pay those yet. They're also not going to include amounts that maybe you purchased last month, but you actually paid the cash out this month or this year or whatever it is. As we said, the taxes will, if there is an interest expense on the financial statement, then the taxes will reflect the benefit of that interest expense. May not be the case for all of them, and so you may not have to deal with that. That would be nice. And obviously, just looking at the income statement and balance sheet, there's no separate entry for asset or sales or purchases. Fix that typo here, sorry. It's just a thing I have here. You've got to understand that's just how I am. So there's nothing in there for asset purchases or sales. Sometimes you can pick those out of a statement of cash flow, but sometimes that's just not available to you, and so you've got to figure out how to get it off of the balance sheet. All right. So here's kind of the way that you would go about doing that. For the operating cash flow sales, you could take the accrual revenues or sales, and you would subtract from those the change in accounts receivable. You're subtracting that, if you think about change from last period to this period, if accounts receivable are going up, that means that the amount that you didn't get paid for this period is more than the amount that you maybe got paid for from last period, right? Or however that works. But basically, the amount that's being borrowed from you without you actually getting the money has gone up, and so your cash revenues are less than your accrual revenues by the amount of this change in accounts receivable. In terms of expenses, works the same way with accounts payable. If your accounts payable are going up, that means that you didn't actually have to pay those expenses yet, right? You got to put them off until next time. And so if you take the change in accounts payable from this period versus last period and subtract that from the operating expense, you get closer. Now with operating expenses, you also have this inventory issue. And that inventory issue goes a little bit like this. You're going to, in reality, let's just say that you decide that you need to have more inventory on hand this period. And so you're going to make those purchases and you're going to put it into inventory. Cash is going to go out, right? But they're not necessarily going to show up in the expense, because not only is accrual expense about matching the timing of when a decision is made, but as it relates to operating expenses, particularly, for example, cost of goods sold, so things that are directly related to the cost of generating revenue, accrual uses a matching principle that says that we would recognize the cost of goods at the time that we make the sale as opposed to the time when we actually expend the money. And that's a problem, right? And so during that period of time, we may be building up an inventory and not really recognizing that as an expense. Well, if we show the change in inventory, a positive amount, let's say, of a change in inventory, and add that to the expense, that'll take care of this. You've also got an adjustment, obviously, for taxes. We want to add back any tax benefit of interest expense. And the way we would do that is we first have to calculate out what I will refer to as your effective tax rate. And that's just whatever your taxes are on your accrual report divided by what that taxable income was. So if you divide those two together, you're going to get some percent that says your taxes are, 22% of your taxable income, whatever it is, okay? And we're just going to make a simplifying assumption that effective tax rate also applied to the interest expense. And so if we take the interest expense times this effective tax rate, that's how much your taxes got reduced by including the interest expense. Now, I will agree with you that is not a perfect and exact calculation. And if your interest expenses are very large relative to everything else, you may want to go through and actually recalculate the taxes using a revised taxable amount. But for simplification purposes, this will work, right? And so that's all I'm suggesting here. And so at the end of the day, you would take those taxes and add back that tax benefit, because it's not really a tax benefit for operations. It was a tax benefit from financing. And then as it relates to the investments and sales, again, there's not an income statement account you go pick up, but you can just go look at the value of your fixed assets, not the net value, not the value after depreciation, but just the value of your fixed assets. And that value will be reduced whenever you sell off those assets, and it will be increased if you buy assets, and it will reflect sort of their value, and so you could take the difference. Now, I'll be the first person to say that's not perfect, because when you sell an asset, you're not necessarily going to sell it off at book value. So that's a little bit of a problem. But this is a reasonable first approximation. If you did actually have income from the sale of an asset and that income was taxable, that's going to show up someplace up in the income statement. So perhaps the combination of removing the asset from the fixed asset account plus recognizing the operating income or the income from the sale of that asset above, those two will sort of balance each other out. All right. Same thing if you were to just go out and buy more assets. Let's say your business gets bigger and you need to buy more assets. The value of the fixed asset account would go up, and so this change would be a positive amount. Okay. And you're actually, I didn't put it in here, but you're going to subtract the change in the assets from it. So here's kind of how it works. So to get your operating cash flows, you're going to do the operating cash flows from sales. So that's after you've done your adjustments for accounts receivable, less the expenses, less the taxes, and less the asset investments. All right. So when you get done with all of that in any one period, that should be your operating cash flows. Now, I'm just going to go through real quickly and show you that by example. I've got here a spreadsheet, and it looks a lot like the spreadsheet that I've developed for your forecasts. It's a little bit different, but just imagine that this is a accrual-based spreadsheet, and so all of this is actually done on an accrual basis. It is a forecast, but we need to somehow turn it into operating cash flows. So we would start out by saying, oh, I got to take my receipts. So go back up here and find my revenues. Okay. I've got to do the change in AR, and since I'm in the first period, my accounts receivable change is just equal to whatever the first period accounts receivable are. Let's see, that's there. They're nothing. I'm not sure I even have accounts receivable on this one. I don't know why that's doing that. Equals. But anyway, this is just for completeness. And so if I do the receipts minus the change in accounts receivable, that becomes my OCF sales. Then I've got the operating expenses, which I'm just going to go up and grab. And that for me is equal to the sum of the two variable cost items plus my period costs. And sometimes, particularly on published financials, that may be all you get. There may not be a lot of a breakdown there. And then equals the change. We're in the first period, so that's not really going to work. But you'll see I don't even have an accounts payable here. If I did, then I would put something else, but otherwise this is just zero. Change in inventory, again, I'll just do whatever inventory is right now because the assumption is that whatever it is now, it was zero before. All right. And so to get to my operating expenses, that is equal to this minus this plus this. All right, so pretty easy. All right, I need to do a little highlighting here. Sorry, you know how I am. I just got to keep this stuff kind of clean. All right, and then for the taxes, I'm going to go grab my taxes. There they are. And I've got to get that interest tax benefit, or so that is equal to the amount of taxes divided by the pre-tax income. So that gets me to a percentage, right? And oh gosh, since I'm in a period where I have no taxes, it gives me that division by zero. And so that really means I could just put a zero in there. And so I'm going to use an Excel function called if error. All right, and what if error does is lets me do a calculation and tell me what to put in if I get an error. So it'll stick in that zero, which is awesome. And I'm going to multiply that effective tax rate that I've calculated there by what my interest expense is. So there you go. And so, oh, that was supposed to be tax payable, sorry. There is no tax payable up there. I know that for a fact, so I'm just going to stick in a zero there. Sorry. Maybe not the best example, but there we go. And so my taxes are equal to what I paid minus the change in the tax payable minus the interest benefit. And I think that's backwards. My taxes need to be higher for the interest benefit. So that actually needs to be added. Because that's the whole issue here, is that including the interest reduces my taxes when it shouldn't. And then we've got the change in operating assets, and in this case, I do have my long-term assets up here, my fixed assets, and I'm just going to assume they were 0 before, so there we go. All right, and so that's just equal to that. All right, and so my totals become equal to, we're adding that, we're subtracting that, we're subtracting that, and we're subtracting that. Right, so we started out with sales, we've subtracted purchases, we've subtracted taxes, and we subtracted investments and operating assets, and so that's our total. Now, don't know why, hit something wrong there. So sure enough, our operating cash flows there go to 0, or go to minus 308 because we've spent on that. I'm going to extend that to the right. I have to make a couple of formula changes where I've got anywhere in here that I've got this change in something. I now have to do minus the column before, so that's B20. Change in AP doesn't matter because it's always going to be 0. Change in inventory, C21 minus B21. All right, change in tax payables isn't going to matter. What I do there? I'll go equal 0. For some reason when I do, if I don't do an equal and I drag it over, it causes that problem. The tax benefit's not a change in. The operating assets, that's a big one. I got to do that, otherwise it's going to be carrying over the whole value. It'd be like I reinvest that every time. So now I can take this and start to move it to the right a little bit, see how it shows up when I have some real numbers in some of these cells. So let's just we'll go out here to year 2. So let me scoot that over so year 2 is right next there. All right, we'll do year 2 versus year 3. So we're really looking at the year 3 operating cash flows, and we want this other stuff to think changes. So my receipts were 786, that's good. Change in accounts receivable is nothing because I don't have any accounts receivable, so my sales are that. Operating expenses, 471, 925. My inventory went up, which means that in addition to what this says I spent, I must have also spent some money on inventory. So that's got to be reflected in there. The operating purchases are just the sum, operating expenses less change in AP, add the inventory, so we're all good there. The taxes, here's the $66,112 that we paid in taxes. We didn't have any tax payable, but I have a $4,842 interest tax benefit, and so that shows up because we had $19,370 in taxes, and I could very quickly kind of go in here and say, oh, what was my effective tax rate? And that's just my taxes divided by taxable income up here. I have to put that in percentage terms. About a 25% tax rate. So that's, you know, that's where that comes from. So I got to add that tax back here, which I did. All right, and so that gets me to $70,000 worth of taxes. If I hadn't had interest, I'd had to pay $70,954 in taxes. I had another change, I think, in operating income here, or in operating assets here. Let's see. Yep, I was at 308. I went to 408, so I must have bought $100,000 worth. So that changes in there. All right. So now when I go out and say, so how much do I have in OCF? Let's see if I did this right. It is that amount minus that amount. So 55 minus 59 minus 63 minus 65 It's not coming out right, is it? 55, 59, 63, 65. Not sure what's going on there. Let's see, P55. So I have 786 minus 470. See, this should be a much smaller number because that's not negative. Minus 70. Oh, hello. It's right there staring me in the face, isn't it? That should be a minus right there. All right, much better. So I've got to fix that formula all the way across because I clearly screwed that up. Don't know why I would have thought that I'd be adding in. Oh, I remember when I put this formula in, I had some funky error. Okay, so just goes to show you, when you're working in a spreadsheet, you got to pay attention because things will not work out. But anyway, so it shows about 143 in operating cash flows. If I went and compared that to just the net income said, 198. So it was higher, partly because of the adjustment to taxes, partly because of this, and partly, the additional investment, and partly because that number also includes a depreciation expense, right, that we didn't really have, and so we get to add that 30,000 back, basically. That's a simple way of doing this. You can do your own research, and you're going to find out there's 4 or 5 different approaches, top down, bottom up, piece by piece. There's all sorts of different ways that you can get to these OCFs from Accrual Financials. I just thought I would show you one that I think I like it because I find that what the other ones do is sort of just, give you shortcut formulas that don't really tie to how each account affects the other accounts, and I like this approach because it ties them together. Anyway, hopefully that's useful for you. As always, if you have specific questions or something you don't understand, just bring it to class and we'll discuss it. Thanks.